You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Once this correction is over, also from an Elliot Wave point of view, you can expect a very, very strong rally, because this will be phase 3 in the Elliot Wave count, and that's the strongest phase, and it will take longer than the rally we saw last year, and it will bring more profits percent-wise compared to the rally we had last year. So this is a time to buy. This is not a time to sell.
I'm Bill Powers. Thanks for tuning in to Mining Stock Education. And in today's show, we're going to be hearing from Willem Middelkoop. He is a fund manager with the Commodity Discovery Fund. 7 months ago, we checked in with Willem about where he was putting his money, and he gave us his thoughts on the precious metals. Well, that was the peak at that time, so I'm interested to get an update. Willem, welcome back onto the show. And since your fund invests in discovery plays, thus the name Commodity Discovery Fund, but you also use the Elliot Wave analysis, technical analysis, to determine tops and near-term bottoms and such. So if you discern a top and then you expect it trending down for a period of time, several months, does that affect when and how you invest in these discovery plays?
No, not on the real world-class discovery plays. Our portfolio is constructed like this. 50% of our portfolio is buy and hold in the top 50 best mineral metal discoveries worldwide, one could say. Metal agnostic. So when we have a position in the gray mining or Greatland Gold or Great Bear Resources, we don't scale them down because gold or silver is reaching a intermediate top according to the Elliot Wave count. So, but the other part of our portfolio, the other 50%, is invested in more liquid stuff, let's say the ETFs, the royalty plays. And these positions we trade a little bit more based on technical indicators. And a great example was the rally we experienced last year in the precious metal sector, which topped out in early August after a very strong bull run, which gave us 5 months in a row with double-digit returns. And after doing the Elliot Wave analysis, it turned out that August could well be an intermediate top. So we really scaled back our precious metals investments. So we took quite a bit of profit. We switched quite a bit of our portfolio to other metals like uranium and silver. And because of this, our fund is up 10% compared to August last year, while the GDX and gold equities are down 35%. So I think it pays off to have a very active portfolio management. People always say our fees are quite high. We have a performance fee of 20%. But if I tell them that the GDX returned 24% last year in 2020 and we returned 85%, you're happy you can pay a performance fee of 20% because it still brings you a lot more than just following one ETF.
Do you notice, does your Elliot Wave analysis coincide with the feedback and the emotions that you hear from your investors in terms of, I'm going to take my money out? I mean, how do they coincide?
Yeah, the last week is a typical example that people are sending mails. I'm getting worried because you have been going down for 3 months in a row and you're down 6% year to date now after a run of, 85%. And people always expect their investments to go up every week or every month. We had huge inflow in the last few months. So all these new investors, they want to see stocks going up, of course. I understand that. But this negative sentiment coincides with the Elliot Wave count. And if you look at Elliot Wave, you always have an acceleration in the downturn, and that's most of the time the end phase of the correction. And we had an acceleration in decline of gold price this week. We went south of 1,700. And we were quite sure that this marked the bottom. And we were active in the market to buy this week. I think we ended the month down March 1 or 2%. So that's a very small loss. And once this correction is over, also from an Elliot Wave point of view, you can expect a very, very strong rally, because this will be phase 3 in the Elliott wave count, and that's the strongest phase, and it will take longer than the rally we saw last year, and it will bring more profits percent-wise compared to the rally we had last year. So this is a time to buy. This is not a time to sell. And I gave another interview in which I predicted, or I said, I expect the next rally to see later this year. It could start even this week or next week. But the next rally will, I think, bring returns between 30 and 80% in our space. And I'm still a bit conservative by giving these numbers, because I wouldn't be surprised to have a 100% move in the GDX or the SIL, because if you look at silver, that's an explosive situation out there.
So when you say 100% move, in this year or just in the next leg 3?
In the next rally, I wouldn't be surprised to see a 100% move in gold and silver related equities, especially on the junior side. And the next rally could start as soon as this month. And I think that rally will take at least 7 to 15 months to complete. So it could bring us well into 2022 as well. But if you look at other technical indicators, if you look at other charts, we just finished a very long bottoming pattern. If you look at silver or the GDX, you have the cup and handle formations. You have these ultra long bottoming formations. If you look at the HUI index and compare that to where it was trading the last time, was trading around 1,700, 1,800, in 2011. It could double overnight and still not be very overbought based on the fundamentals. If you look at the one example, we're buying a junior gold miner, Caliber, which is producing gold from two mines in Nicaragua. I visited them last year, just before the lockdown. They have a PE of 5, and they have huge exploration upside. They just signed a deal with Rio Tinto to explore Nicaragua together for the next 10 years. I've been there myself. The country is very underexplored, so you get all the exploration upside for free, and you have a producer trading at the PE of 5. It's amazing.
Do you think that's because of the jurisdiction? Is that why it's so discounted?
It's even more discounted because of jurisdiction. But if you look to our industry as a whole, there's so much value out there, especially in the junior space. We still invest in companies which have great assets. They already have a discovery, and then they're trading. The full market cap or the full enterprise value is around 20 million. Look at tech stocks. They're not valued at 20 million. They're valued at 20 billion. So there's such a strong undervaluation in commodities, and actually, we follow one indicator closely, and that's the valuation of commodities compared to S&P 500. We made a 100-year low in November 2020, a 100-year low in the valuation of commodities compared to the S&P 500. We had a retest of that low last week. So, yes, last year we had an 85% return, and you can still invest. You can still start investing at a 100-year low valuation in the commodity space. So it's insane, especially if you take into effect the amount of money creation. And the IMF just decided to build a whole new layer on top of the fiat system by creating a large amount of SDRs now. And I think it has never been more interesting to start investing into this space, like the moment we have now, because we know the bull market has started. You didn't pick the exact bottom, but you're very close to the bottom, and the upside is incredible. And yeah, sorry for my long answer, but I just was reading a study by Bloomberg this morning. There has been a 7-year production deficit in palladium. There has been a 5-year production deficit in platinum. We have a list in our office of all the metals showing a production deficit. So that means the physical demand higher than world mine production. And there are 10 metals on that list. And that list is growing every year.
Doré Copper Mining is a premier, near-term, high-grade copper and gold redevelopment opportunity with tremendous exploration potential only 14 kilometers from the town of Chibougamau in mine-friendly Quebec. Doré Copper is debt-free and owns a 2,700-ton-per-day mill with an 8 million-ton tailings facility ready to be used. There is already power to site, and it is accessible by paved highway and rail. Doré Copper aims to produce a profitable hub-and-spoke operation of over 100,000 gold equivalent ounces per year, or over 60 million pounds of copper equivalent by 2024. Because of the existing infrastructure and location, a low capex is anticipated to recommence production. Doré Copper trades under DCMC in Toronto and under DRCMF on the OTC. To learn more, go to dorecopper.com. That's dorecopper.com. Willem, I remember a year ago when we spoke, one of the things you said was that we're facing a once-in-a-lifetime commodities bull market. And I've talked to several people over the last few months, and the jury is still out for a number of them, analysts that focus on commodities, and they're not convinced that we're going to see a commodity super cycle. And they're not convinced, some of them, that we're going to see high inflation. So when you look at your thesis and your expectation as you're laying it out, what would be possible weak links in your thesis if you had to identify them yourself?
There's only one risk, and that's a deflationary collapse. And we all know it ain't gonna happen, because central bankers, we had a deflationary collapse in 2008. We had a deflationary collapse in March last year. And you know what central bankers do? They will double down. They double down. Look at the growth of central bank balance sheets after the corona crash of last year. It was times 3 or 5 compared to after the Lehman crash. Before the Lehman crash, the central bank balance sheets, the total amount of central bank balance sheets was less than 5 trillion. It's almost 30 trillion now. And we see an acceleration of the trend. So the money printing is getting into overdrive. We have the IMF now building this SDR layer on top of the current fiat money system. I wrote a book in 2013. It's called The Big Reset, predicting that one day the IMF would begin to start using their balance sheet, because the IMF has a virgin balance sheet. So they can print trillions and trillions. And it's a great way to hide more money has been printed, because they can hide it. They use the SDR. The SDR consists of the dollar and the pound and the euro and the yen and the renminbi. But they print all these 5 currencies in an indirect way by using the SDR. And when people are interested in this topic, they should go to our website and they can download the Big Reset for free. And it's all there.
So you look for world-class discoveries. In the past, you've told me you're commodity agnostic. Obviously, you focus on the precious metals for the monetary reasons, so you're bullish there. But have you invested in any niche metal discoveries recently? Graphite, something rare earths, something like this?
we have been quite active with some investments into the graphite space and rare earth element space in the last few years. But we learned it's a very, very tough market. The size of the physical metal markets for graphite or rare earth is only a few billion a year. And now all these juniors saying they have the next big thing. And they will all go up in a hype. When there's a hype, we have a hype around graphite. We had some graphite holdings. We sold them on the hype. So I wouldn't advise investors to invest in exploration companies working on these kind of metals, because it's very difficult to do good research, even for us as people, to understand who the winners. And so as a fund, we held back in new investments in the space you mentioned. So we prefer to play the EV revolution, the Tesla revolution, as you might call it. And we prefer to play through the copper and nickel discoveries, because they will be winners for sure. And these markets are much more mature. And there are, of course, always major companies willing to buy these assets. And Blackstone is a great nickel discovery in Asia. That's a great company. We're adding to that one. And we like the big copper discoveries. And well, that's why we focus on.
What about Chalice, that discovery in Australia? Are you in that one also?
Yeah. Amazing discovery, PGMs and nickel and copper. But if you look at valuation, it's almost $2 billion now. Maybe it's not stretched, because it could be a real world-class discovery of size. But we took quite a bit of profit on that one. I think we sold 80% now. We still have a position because, all this could be the new Voisey Bay, but the jury is still out, of course. But once a junior exploration company has seen the run from 30, 40 million towards 1 billion, we always start to take a lot of profit, because it's very difficult for a junior exploration company after a discovery run from 1 billion to 2 billion or 3 billion. So you don't have a 10 bagger anymore after you reach 1 billion. So we prefer to take profit and to invest the money in the new discoveries, which could be another 10 bagger. And especially in Australia, we invested in quite a number of new discoveries who are still valued around 50 to 150 million. And that's the space we like. So when there's a serious discovery and the stock has already jumped from, let's say, 20 million to 50 or 80 million, but when it's a good discovery, 50 or 80 million is still cheap. So we like the run from 100 million to $500 million or 1 billion. That's what we focus on.
And one more question before you go, Willem. Could you describe to us the deal flow that's being brought to you? How would you assess the quality of the deal flow, since you've been at this now for about 15 years?
Yeah, it's almost troubling, the amount of deals we get thrown at us. And we start to be real picky. We did a large number of private placements in April, May last year. But then when we reached July, August, September, we thought the low-hanging fruit was gone, and things were getting a little, maybe overvalued, and everybody wanted to invest in the resource space. So that's when we scaled down a little. Now we're getting more and more selective. We participated in over 100 private placements last year. I think we've done 30 in the first quarter this year, but we want to end the year maybe 60 or 70 private placements. So we're getting very selective. And because our fund has grown quite a bit from 50 million Canadian last year to over 170 million Canadian now, our ticket size becomes larger. So we don't invest $50,000 in a company anymore. It should be at least $200,000 or $300,000. So you get a little bit more selective.
And it makes you have to do private placements in a lot of these stocks because some of them only trade $2,000 to $7,000 worth a day of shares.
Yeah, so you don't have any exit. And look at Eric Sprott. Eric Sprott, he invests in so many companies, hoping that a few will be winners, and that will happen. But he accepts that he can't sell the other ones. They will be in his portfolio forever. But he's investing for his family office or for his own book, and we are investing for 1,400 high net worth investors. And we can't have all these positions in our portfolio which we can't sell anymore. So we will never take that approach. So we're a little different than Eric Sprott. We often are joining him in private placements. We try to be more like a lead investor in certain private placements. We want to be more active instead of reactive. So we want to start to initiate our own deals. We could use a little help in that respect because I think there's a lot of money to be made if you initiate your own deals in which you can ask for a full warrant and you help selected companies to become more successful. And
as part of your negotiations, do you say, we're going to give you 2 million, but you have to cap this raise at 5 million? Because I've seen the lead orders and then the whole placement, the terms are too good. And so it ends up being too dilutive sometimes.
Yeah. Well, of course, as an investor, you're on the good side of the trade when you can say to a company, we have 2 million available for you, but then we want a deal which is very beneficial to us. That's the way Eric Sprott works. If Eric Sprott enters a private placement, he has a profit almost right away because he always enters below the level the stock is trading at. He always gets the warrant, and often because Eric Sprott makes the deal, many other investors follow him and think that's a great company. So when you grow the fund like we have done in the last few years, you get more power in the markets and you can build almost your own success when you work together with good juniors. And I hate to play the Vancouver games in which you finance lousy companies, but just for the cheap paper. So we will only invest in very strong companies and very strong projects.
Excellent. And your website again is it cdfund.com? Yeah.
And if you Google for Commodity Discovery Fund, you will always find it.
Excellent. Well, Willem, I know you were on a ski break. Beautiful cabin there you have in Switzerland. So thanks for taking time out of your day to speak with me.
Well, today I've been on the slopes. There was the very first time in a few weeks because I have Bloomberg here in the office. So this is where I work. So don't get the wrong impression.
You're still working. Yeah. A little work, a little play.
12 hours a day at least.
Okay. Well, you need to decompress, right, on the slopes, to deal with the stress. All right. Well, thank you for coming on today's show.
Thank you again.